Welcome back to the deep dive. Today we're tackling the latest from Netflix, NFLX, but we're not starting where you might expect, like with subscriber numbers.
No, we're starting with something that trips up a lot of people following the market. A paradox, really.
Exactly. It's that classic disconnect, isn't it? You see a company like Netflix here in Q2 2025 just nailing it, strong financials, beating expectations on profit.
Flawless execution on strategy, pretty much.
And yet the stock still drops after hours. It's confusing.
It really is.
It feels like, a total head scratcher. You read the headlines, Netflix beats EPS, profits soar, and then you actually watch the stock price dip. All that noise.
It drowns out the signal sometimes.
Right. So our mission today is to cut right through that noise. We want to give you a framework to understand why this stuff happens and, maybe more importantly, what the real health of the business looks like underneath it all.
Yeah, we're going deep into these Q2 earnings using a structured 5-part framework. It's super important because it forces us away from just that knee-jerk market reaction. We integrate the company's actual data with, let's be honest, the very high expectations the market had already baked in. We're hunting for the real drivers of performance, the stuff that lasts, not just the daily sentiment swings.
And we're going to walk through this step by step, slide by slide, following that framework precisely. It lets us systematically look at, well, how they're running the business,
Operational execution, yeah.
their financial strength, and critically, what management sees coming down the road, their outlook.
Which is key for future returns.
This structured approach, really, it's your shortcut to getting beyond the headlines on Netflix's big transition.
Because that's what this is, fundamentally. It's the story of Netflix moving past just chasing growth, growth at any cost.
Right.
And really turning into this cash-generating machine focused on leveraged profits.
Okay, let's unpack this then, starting with slide 1, the at-a-glance scorecard.
Perfect. So this scorecard, think of it as our high-level snapshot, the headline numbers for Q2. And we're looking at them two ways. Year-over-year change from Q2 2024 and how they stacked up against what Wall Street was expecting, the consensus.
And on paper, these numbers look pretty fantastic, actually. They really seem to confirm that the strategic shifts they've made are working.
Absolutely. So starting at the top line, total revenue came in at $11.08 billion.
Okay.
Which is a solid, very respectable 15.9% growth compared to last year.
Yeah.
Healthy number. But that growth, it kind of gets overshadowed by what happened on the bottom line.
Yeah, the profit story seems much more dramatic here.
It really soared. Net income attributable to shareholders hit $3.13 billion. That's 45.6% growth year over year. Just massive.
Wow.
And that flows right down to the metric everyone watches. Diluted earnings per share, EPS, that hit $7.19.
$7.19.
Which is up an incredible 47.3% from the year before. Just staggering growth there.
Okay, hold on. Before we get to the market's weird reaction, let's just quickly define diluted EPS. We hear it all the time, but why diluted? Why is that the number analysts focus on?
Good question. It's basically the most conservative way to look at earnings per share. EPS is simple enough.
Right.
Profit divided by the number of shares.
Right.
Basic EPS just uses the common shares that are out there trading right now. But diluted EPS, it factors in every potential share that could hit the market.
Yeah.
Think stock options, warrants, convertible debt, anything that could potentially turn into a share later.
So it assumes the worst case scenario for dilution.
Exactly. It uses the biggest possible number of shares in the denominator.
Yeah.
That gives you the most conservative, sort of fullest picture of what each share's claim on profits really is. It builds in a safety margin for analysts.
Got it. So that's $7.19, the conservative number. How did that stack up against the consensus expectations before the stock price even moved?
Well, that's where the beat comes in. It was a clear beat on profit. Revenue, though, was almost dead on. Consensus was looking for $11.09 billion in revenue. Netflix delivered $11.08 billion. So basically right in line. No surprise there. But the consensus for diluted EPS was $7.07. So when they posted $7.19...
It's a solid beat.
And it's a decisive beat, yeah. Operationally, this is exactly what the street wanted to see. Strength in the margins, profitability coming through.
Okay, so clear EPS beat, almost 50% profit growth, revenue in line, operationally sound, and yet the stock price dropped about 5.1% in after hours trading on July 17th. This is the paradox we started with. How does that even happen?
Yeah, it's the fundamental challenge, right?
Okay.
Investing in a company that's already doing really well. Analysts quickly labeled it a sell the news event.
Which always feels a bit simplistic.
It is too simplistic. You absolutely have to look at the run-up before the report. Netflix stock had been on an absolute tear leading into these earnings.
Right. Didn't you say over 40% year to date?
Over 40%. Just phenomenal.
Yeah.
So what that means is the market wasn't just hoping for a good quarter.
No, they were expecting it. It was priced in.
It was totally priced in, maybe even pricing in something better than perfect, an impossibly good quarter. Flawless execution had become the absolute baseline expectation.
So when the results came out, even though they were objectively great,
They weren't shockingly, unpredictably amazing enough to justify pushing that already high stock price even higher. There wasn't that massive, unexpected upside surprise.
So if expectations are already sky high,
Then the stock becomes really sensitive. Even a tiny perceived disappointment, or maybe just the lack of a huge new catalyst, can trigger selling.
so the dip wasn't really about bad performance. It was more about the stock price just getting a bit ahead of itself and needing a breather, a reset.
That's a much better way to frame it, yeah. That's the takeaway on the price action. But while that grabs the headlines, the really critical financial data point on this whole scorecard is that huge gap
The gap between the 15.9% revenue growth.
and the 47.3% profit growth.
Yeah, profit growing almost 3 times faster than sales.
That massive acceleration. That's what we really need to understand. How does that happen?
What's the mechanism there?
Well, we can point to two main drivers right off the bat. First, huge operating leverage. Their whole profit structure is just geared to grow faster than sales now.
Okay.
And second, some active financial engineering. They've been buying back a lot of their own stock, which artificially boosts those per share numbers by shrinking the share pool.
Got it. And we're going to break both of those down.
Yep, those are the core stories for the next few slides.
All right. Moving to slide 2, the engine of profitability.
Perfect. So this slide gets into the structural changes that have really fundamentally changed Netflix's financial path. If slide 1 gave us the impressive results, slide 2 explains the how, the mechanism, and it boils down to margin expansion.
Right, operating margin. Crucial for any platform business like this. It tells you how efficiently the core business is running before you even worry about interest and taxes.
Exactly. And Netflix delivered a really significant improvement here. Their operating margin jumped from 27.2% in Q2 last year all the way up to 34.1% this quarter. That's a 6.9 percentage point increase. That is huge for a company this size.
Yeah.
Massive leap.
And that expansion, that 6.9 points, that's what fueled the huge jump in net income and EPS we saw on slide 1.
That's the financial engine right there.
Yeah.
And to see how they did it, we need to look inside their expense structure. That's where you find just incredible evidence of operating leverage.
Okay, let's break down operating leverage simply like in the context of streaming.
Sure. So in any business, right, operating leverage happens when your profits grow faster than your sales. Why? Because some of your costs, your fixed costs, stay relatively stable even as your volume goes up.
And for Netflix, the big fixed cost is?
Content, their massive library. Think about it. They spend billions producing something like Wednesday or Squid Game.
Yeah.
Once that money's spent and the cost is being amortized over time, the actual cost of letting one more person or the next million people stream that show is basically zero.
Right, the marginal cost is tiny.
Tiny. And this quarter, wow, incredible proof of that principle. Overall revenue grew, what was it, 15.9%?
Yeah.
But their total operating expenses,
Yeah.
managed with extreme discipline, they grew much, much slower.
And the key line item is?
Cost of revenues. That's mostly their content amortization. That line item grew only 2.9% year over year.
2.9%.
Yeah, just pause and think about that. They brought in nearly 16% more money from new subscribers,
Right.
the ad tier kicking in, paid sharing converting accounts,
Right.
and the cost of the actual content that generated that revenue only went up by less than 3%.
That 2.9% number, that feels like the punchline for their whole strategy shift, doesn't it? It kind of kills that old narrative that Netflix is trapped, that they have to spend $20 billion a year on new content just to tread water.
It really does. It confirms the model is scalable.
Yeah.
Now, your question might be, is this sustainable? Do they just need another huge hit next year and costs will spike again?
Yeah, exactly. Is this just a one-off quarter of discipline?
Well, management argues, pretty consistently actually, that this isn't just about cutting cost. It's about efficiency. They're getting smarter. They're leveraging that massive library they already built during the content wars era.
Getting more bang for their buck from existing stuff.
Exactly. They're retiring shows that don't perform. They're renewing hits more effectively. And critically, this is key. The ad tier and the password sharing crackdown mean that the next dollar of revenue they bring in is super high margin.
Ah, right. Because if someone converts from a shared account to their own paid plan, or if they serve an ad,
The content cost associated with that specific revenue is already sunk. It's mostly fixed. So a big chunk of that new revenue drops straight to the bottom line.
so revenue from things like price increases, ads, or stopping password sharing is just inherently more profitable than revenue purely from chasing expensive new subscribers.
That's the dynamic. And the discipline wasn't just in content. Look at sales and marketing. Grew 10.7%. That's slower than revenue growth.
Suggesting they're getting more efficient with their marketing spend too?
Seems like it. Tech and development costs grew pretty much in line with revenue, about 16.0%. So overall, it points to a company-wide shift. Maturity, efficiency.
We also need to touch on the global picture here, the FX neutral numbers you mentioned. Why are those so important?
Absolutely critical for a global company like Netflix. They report their official numbers in US dollars, following US GAAP rules.
Right.
But they make money all over the world. Euros, Brazilian reals, Japanese yen, you name it. Now, if the US dollar gets stronger compared to those currencies, which it has recently.
Because of global economic stuff, interest rates?
Yeah, exactly. Then the revenue they earn overseas is worth fewer US dollars when they bring it back home and report it. FX neutral figures basically strip out those currency fluctuations.
So you see the real business performance.
You see the true underlying growth, yeah. Separate from all that currency market volatility. It isolates operational reality from market noise.
And for Q2 2025, what did that show?
It showed their underlying momentum was actually a bit stronger than the reported numbers suggested. Reported revenue growth was 16%.
Okay.
But FX neutral growth was slightly higher, at 17%.
So the strong dollar was a small headwind.
A minor headwind, exactly. Which means the success they were having with the ad tier, pricing, paid sharing, content engagement, it was actually slightly better than that initial 16% figure indicated.
Interesting. Okay. Now let's look at slide 3. The engine room business segment performance. This is where we see how that leverage and growth played out geographically.
Exactly. And this slide, it's a huge validation of Netflix's whole strategy.
Yeah.
Invest in local content, find a global audience.
Yeah.
Because the growth wasn't just coming from one place. It was really broad-based.
Which is great for risk, right? They're not dependent on just one market.
Massive de-risking factor. Every single one of their 4 main geographic regions chipped in on the top line.
Okay, let's run through the reported numbers quickly. Revenue and growth by region.
Starting with the biggest, most mature market, UCAN, US, and Canada. They brought in $4.93 billion.
And growth.
Still strong, surprisingly strong for a mature market. 15% year-over-year growth, which really points to those new monetization levers working well, like the ad tier, paid sharing.
Okay. Next biggest?
EMEA, Europe, Middle East, and Africa. That hit $3.54 billion and grew even faster, 18% year-over-year.
Then the growth engine, APAC.
Yeah, Asia-Pacific continues to be the long-term driver. Fastest growth on a reported basis, up 24% to $1.31 billion. Their bets on local content in places like Korea, India, Japan are clearly paying off.
Right. And finally, LATAM, Latin America, came in at $1.31 billion, same size as APAC.
But reported growth was only 9%.
Okay, that 9% jumps out. That looks weak compared to the others.
It absolutely does. If you only looked at that 9%, you might think, uh-oh, LATAM is slowing down, maybe hitting saturation. But this is exactly where looking at the FX neutral data gives you that huge aha moment. It completely flips the script.
Okay, so let's do the comparison. Reported versus FX neutral for each region.
Let's do it. UCAN, 15% reported, 15% FX neutral. Rock solid, no currency impact.
Right.
EMEA, 18% reported, but only 16% FX neutral. So they actually got a tiny tailwind from currency there. The underlying growth was slightly less than reported.
Interesting. APAC.
24% reported, 23% FX neutral. Almost identical. Very little currency noise.
Okay, now for the big one. LATAM reported only 9% growth.
Right. But on an FX neutral basis, stripping out the impact of really volatile currencies in places like Brazil, Argentina, Mexico, hit hard by inflation and instability.
Yeah.
Underlying revenue growth in LATAM was a staggering 23%.
23%. That's almost the same as APAC.
Exactly. Puts it right up there with their star growth region. That gap between 9% reported and 23% underlying, that's a 14 percentage point difference.
Wow.
14 points. That is pure currency headwind. It proves the underlying demand for Netflix, their pricing power, their execution on ads and pay sharing is working incredibly well in LATAM. People are signing up. They're accepting the price points.
But those pesos and reals just translate into fewer dollars right now.
Precisely. So if you just read the 9% headline, you might draw the wrong conclusion. But the FX neutral number shows the operational strength is fantastic there.
Which makes the whole global business look much more resilient, doesn't it? It shows their success isn't just tied to stable, rich economies.
Totally. It's proof positive that the global diversification strategy works. You've got UCAN steady, EMEA strong, and then both APAC and LATAM showing underlying growth in the low to mid-20s. That really protects them against any single market having a wobble or even short-term economic shocks.
Very compelling. Okay, let's shift gears. We turn our attention now to slide 4, financial strength and shareholder rewards. This is the other side of the profit story, the financial engineering piece.
Yeah, and this slide, it really captures maybe the most profound shift in Netflix's whole identity. They've gone from being that company always burning cash, always needing more debt, focused purely on grabbing subscribers, to becoming this mature, highly profitable business focused on financial discipline and, importantly, returning huge amounts of cash to shareholders.
Let's start with the balance sheet health. Looks pretty solid. Long-term debt reported at $14.45 billion.
Right, and that's against total stockholders' equity of nearly $25 billion, $24.95 billion to be exact.
Okay, so what does that mean in terms of risk?
Well, if you calculate the debt-to-equity ratio, just divide the debt by the equity, you get 0.58.
Which is low.
Generally considered very healthy, yeah. A DE ratio well below 1.0 suggests the company isn't overly reliant on debt. They're financing themselves more through equity and the profits they keep in the business, their retained earnings. Less leverage means less risk.
And why is that particularly good for a company like Netflix in the content business?
Because content is inherently cyclical, right? And it requires huge upfront investments. Hits aren't guaranteed. Having a low DE ratio gives them tremendous financial flexibility, meaning they don't have massive interest payments hanging over them every quarter. And it means they have the capacity to borrow billions more if they needed to, maybe for a big strategic acquisition, or to fund a huge new slate of shows without worrying about breaking agreements with lenders. That financial conservatism gives them real strategic options.
Makes sense.
Yeah.
Now, the capital return strategy, they don't pay a dividend, right?
Correct. Their only way of returning cash directly to shareholders right now is through share repurchases or buybacks.
And this is the second engine that boosted that huge EPS number we saw back on slide 1.
Directly. Hugely impactful. In Q2 alone, Netflix was actively buying back its own stock in the open market. They repurchased 1.5 million shares and spent $1.6 billion doing it.
$1.6 billion in one quarter. That's a serious amount of cash going back out. And it fundamentally changes the math for everyone who still holds shares.
It does, and that's exactly the intention. Remember, EPS is earnings divided by the number of shares.
Right, the denominator.
Yeah. By buying back shares, Netflix is reducing that denominator. Fewer shares outstanding. So even if the total profit, the numerator, only grew moderately, the profit per share gets a significant boost just from shrinking the share count.
And we can see that reduction clearly in the numbers.
Yeah, the report shows the diluted weighted average share count fell. It was 439.7 million shares a year ago, and it dropped to 434.9 million this quarter.
So that drop is tangible proof. Buybacks are actively inflating the per-share metrics, separate from the underlying business growth.
Absolutely. It's measurable financial engineering. And importantly, this isn't just a one-time thing. It signals a permanent shift in how they plan to create shareholder value.
How so?
They specifically noted they still have authorization from their board to buy back another $12.0 billion worth of shares.
$12 billion remaining.
Yeah. That sends a strong message to the market. We are generating tons of cash now, and returning a big chunk of it to you via buybacks is going to be a core, ongoing priority for us. It's funded by that massive free cash flow they're now producing.
It really is kind of wild to think about the transformation. 5-6 years ago, Netflix was all about cash burn, needing more debt.
Constantly raising capital.
And now they're talking about disciplined finances and forecasting, what, over $8 billion a year in free cash flow?
It's the textbook definition of a company maturing, moving from that high-growth, high-beta tech stock phase into becoming this efficient, leveraged, almost blue-chip media powerhouse. Which brings us nicely to the future outlook.
Okay, great transition. Finally, let's explore slide 5, the road ahead management's outlook and key takeaways.
Right. And often what management says about the future after reporting earnings is even more important than the quarter they just finished. And here the communication was just brimming with confidence.
It was a classic beat and raise, right?
Textbook beat and raise. They beat the Q2 expectations we talked about, and then critically, they raised their own forecasts for the rest of 2025.
So what are they predicting for the immediate next quarter, Q3?
They're guiding for 17% revenue growth. That's actually slight acceleration from the 16% they just posted in Q2.
Okay.
And they expect to keep profitability very high, forecasting an operating margin of 31% for Q3.
And for the full year 2025, they raised the goalposts there too.
Significantly.
Yeah.
The full-year revenue forecast got a big bump. They now expect it to land somewhere between $44.8 billion and $45.2 billion.
And the old range was?
$43.5 billion to $44.5 billion. So that's a substantial lift, not just fiddling around the edges. It shows real confidence that the ad tier, paid sharing, and pricing power are delivering sustained results.
They also boosted the full-year operating margin target.
Yep, raised it to 30%. Now, given they just hit over 34% in Q2.
Targeting 30% for the full year sounds achievable, sustainable.
It suggests they believe that high level of margin performance is the new normal, that the leverage we saw isn't just a one-quarter blip, it's structural.
And the cash flow forecast, that got raised too.
Big time. Free cash flow FCF forecast was raised to between $8.0 billion and $8.5 billion for the full year.
$8 to $8.5 billion.
Just a staggering amount of cash. And remember, that's the money that funds everything else. The buybacks, any future M&A, ongoing content investment, potentially all without needing to take on any new debt.
Their mission statement seems really clear now too, based on the shareholder letter.
Yeah, they stated it plainly. To sustain healthy revenue growth, expand operating margin, and deliver growing free cash flow. That's not the language of a company just chasing subs anymore.
No, that's the language of a mature, durable business focused on efficiency and profitability.
Exactly. So now let's pull it all together. Synthesize these 5 slides into the key takeaways you should really walk away with.
Okay. Takeaway number 1. We started with the paradox. Execution excellence met by a priced for perfection market.
Right. The stock dip happened despite the strong results because the market had already priced in perfection, maybe more than perfection, after that huge run-up. The dip was about valuation resetting, not a sign of operational problems.
Got it. Takeaway number 2.
Operating leverage is the new growth story. This is the core financial engine now. EPS growing nearly 3x revenue. That proved their cost discipline, especially that tiny 2.9% growth in content costs, is structurally boosting profits, and it looks sustainable.
Okay. Third takeaway.
Shareholder returns are now a core priority. The pivot to generating massive cash is real and durable. That $1.6 billion buyback in Q2, plus the $12 billion still authorized, shows that using financial engineering shrinking the share count is now a permanent part of their toolkit for boosting per-share value.
Makes sense. And the final key takeaway.
Global diversification provides resilient growth. That FX-neutral analysis was key here. Seeing the real underlying growth in LATAM at 23%, despite the reported 9%, proves their global strategy works. It de-risks the business from relying too heavily on any single economy or currency.
So wrapping up the narrative for Q2, the results really confirm Netflix has successfully made this huge strategic shift. They're focused on durable growth, profitability, free cash flow.
All powered by that margin expansion from operating leverage and amplified by the share buybacks. You really have to look past that initial sell the news reaction.
Right, because the actual operational performance, and especially that raised guidance for the rest of the year, points to a company that's really hitting its stride, achieving a new level of maturity and efficiency.
Definitely. And that structural shift, that proven leverage, especially with content costs being so well managed, it leads to a really interesting final thought for you, the listener, to chew on.
Okay.
Based on that incredible leverage they showed, with content costs only growing 2.9%, what is the actual long-term ceiling for their operating margin? If they can keep leveraging that fixed cost content library and monetize effectively without huge new spending sprees, could they push margins sustainably into the high 30s? Maybe even 40% someday? And if they could do that, what does that imply for the long-term valuation potential of the stock? It really reframes the whole investment case going forward.
That's a fascinating question to ponder. Okay, before we wrap up, we do have a couple of important disclaimers.
Yes. First, please remember this report is purely for informational purposes. It is absolutely not financial, investment, legal, or tax advice. Any investment decisions you make should be based on your own thorough research and always in consultation with a qualified financial professional.
And also, just to note that this analysis was generated using an artificial intelligence model. It integrated official company data with publicly available market information. We strongly encourage you to independently verify all the information presented here before making any decisions based on it.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.